Well, I think we're live on YouTube, live to the world. I hope you're all well. Welcome to Cheltenham, Gloucestershire on this rather lovely morning. Actually, it's 4th of February. We're good to go on the mortgage side of things for you to update you on what's been going on. I'm Paul Archer. Hope everything is fine with you. Got any questions, please ping them over to me. Happy to help you along the way. So what have we got for you today then? Well, we've got some updates for you on a couple of really meaty topics for you. Got updates on the execution only, which I think is really, really cool thing going on along the way. So we've got that coming up for you shortly. So a quick look down there for any issues around YouTube. So a quick look down to see what's going on here. So I'm going to play on that one, and all is fine. So let's get on with our first topic area then for you to help you with your CeMAP learning and all mortgage CPD updates, whatever it is your choice. First one I want to take a look at for you then is the subject of execution only. So let's put a little title up here on the screen or on the whiteboard. Execution only, we're talking about here. Now, we're talking about mortgages, and the FCA, in their wisdom, I think they're being really upfront about, really modern actually with this one, have decided to change things. And they've introduced a new concept around execution only. They're allowing it to happen, which is brilliant news. Now, execution only, as you appreciate, is where the client or the customer requires no advice. They say to you, look, I don't want any advice, I just want this. And that's what you give them. Now, up until now, it's not been allowed. MCOB kind of destroyed execution only. The Mortgage Market Review in 2014 put the death nails on it. And the Mortgage Market Review got rid of information only, not advice, but you give people decision trees and they could decide what they wanted and what they didn't have as well. Now that kind of killed off any other types of advice apart from advice only. You could only give advice. And around about 30% of the market then was information only, to let people make decisions for simple products anyway. That's all gone now. But of course it's changing as always. And from 2020, the FCA decided to change the rules. What they decided to do is to make execution only allowable on selling mortgages. And they've brought in 4 or 5 changes. I want to just highlight those for you because they are from immediate effect. So they don't muck about anymore, the FCA. They get straight down to making rule changes. They've given everybody until July this year, 2020, to fiddle things around and make sure everything's working fine, but they've actually started them from now. So where's the changes? Now, what you want to do now is take a look at this practically. Now, my son Lewis, he's 25, 26 this year, and the last thing he would ever want to do is rock up face-to-face with a mortgage advisor. I'm sorry, brokers, he wouldn't want to do that. He's a typical generation glued to his computer. And what Lewis loves to do, of course, is go to his phone. So let's draw a picture of a phone screen for you, or his tablet, whatever he's got iPads and everything. Now, what the FCA have done now is they're changing things. So if Lewis goes online to start looking at some lenders or a place where he can get some details of mortgages and things like that, any tools that allow for searching are not advice. So when you have tools, for example, that allow you to categorize mortgages, to search, to filter on income, interest rates, fixed, whatever, if your app allows people to filter all that lot, that's not giving advice. So the FCA said, yes, you can do that as much as you like. And that's great. So Lewis will go in there and start figuring around. And then, of course, it allows plenty of audience or customer interaction. What Lewis might do, you might click on a link where there's a video picture there of an advisor doing her thing. And there's a pretty picture there of an advisor. But the point is, though, that any discussions that you do prior to any decision about the mortgage you have, any interaction with customers via video or whatever, you can do as much as you like before you give advice. And that's brilliant. So Lewis might have questions, he might chat about stuff as well, say he wants this, and they'll give you information, talk about the product, they'll ask questions, not advice, but all that's allowable as well. And that's the second thing that the FCA have done. And then the best thing is they then made it easier for your sales channels to allow for execution only business. The FCA said, look, if you want to make your sales channel allow for execution only, then you can do so. So what Lewis then says is, okay, I'd like one of those then, please. So he ticks the box or whatever, and that is execution only. He's not received any advice. He's had lots of filtering going on, and he's got a good site that's helped him, or an app that helped him decide which lender is the right one. He may even have talked to a live person who's given them information, answered questions, and then he decides to go for it. FCA have allowed that now. Now that is pretty cool. That is what they want to do. They want more online lending facilities available to people. And I think that's great. A couple of other things they've done as well. They've made it so that if you are going to give advice, you don't have to advise the cheapest mortgage deal, as long as you explain why the one you're recommending is better. So because they're getting away from price only, you don't have to recommend the cheapest mortgage if you do give advice as well, because you need to take into account customers' circumstances as well. Where else will this affect the market? Well, it will affect the market with switches, won't it? Think about it, with switches. Somebody comes to the end of their 5-year deal, for example, and they go back to their existing lender, and they switch over to a new 3-year deal or whatever, or convert the mortgage or whatever it is. They can do that online, execution only as well, and that causes help lenders a lot in that respect. Be careful of that on brokers, because you need to be in touch with your customers to make sure they switch with you, or go to a lender that pays you some kind of proc fee if the customer automatically renews as well. So the upshot of this, well, there's going to be a whole lot more direct business of clients or customers going straight to some app owned by a brokerage, possibly, where they can select their own mortgages and execution only their own products. It will happen, maybe more for simple mortgages, but as mortgages get more complex, these young people know how to learn these things. They are switched on. They can talk to people to answer questions, so they don't actually get advice anymore. That's the big point. A lot of mortgage advisors just give information anyway, and we advise a product at the end of it. So look at the difference there. So customers will avoid brokers. They will. You have to work on that. You have to make sure you're dealing with maybe more specialist areas, or you give something else other than just mortgage advice as well. The trade bodies are up in arms about this, of course. Amy and up in arms say it's going to end the world. I don't think it will. I think it's a good thing. Well done, FCA, for doing this. It's the way the world is moving. You can't stop change. And Lewis and people like him are going to be well pleased with this one. So watch this space. Lots of changes going on. I'll keep you informed. As a mortgage advisor, mortgage broker, you do need to make sure you provide something in addition just to giving advice. That's the thing. I once heard a story on LinkedIn about this young lady who got herself qualified, and she suddenly announced to the world that she was available to give advice and had no business, and wondered what was going on. The pure fact is, people don't really want advice. They want guidance, questions, somebody to trust, somebody's going to help them along the way, deal with the paperwork, admin, find the right mortgage lender, maybe twist some arms at the mortgage lender, help them with wills, lasting power of attorneys, protection. There's a whole lot more than just the mortgage itself. You've got to provide that much more. So there's an update for you on execution only. Hope that's been useful. Bye. Do you like that one? Yeah, scary. A lot of brokers up in arms about it. Advice is not the be-all end-all. People don't need it. That's the whole point. The world is changing. People can get information as much as they want. So that's a good thing that the FCA are doing, isn't it? It really is a good thing. Okay. So what I'd do now then is move on to another topic for you. Catch up on a couple of loose areas for you of information that's kind of adding to the boot camp, giving you some more information on a couple of topics. This is about lenders who find it difficult to lend to people because people don't fit criteria. This one's all about guarantors. Yeah, let's take a look at, in a bit more detail than before, the topic of guarantors. So let's put, as always, a nice big title up on the screen for you, guarantors. Yeah, guarantors. Now these have been in the press recently quite a bit. A lot of people talking about these, a lot more lenders getting involved in guarantors. So why, first of all, would somebody want a guarantor? Why would a lender want a guarantor? Well, the pure fact is the lender has the security. There's your property, a nice little chimney there. That, of course, is the security for the lending that the lender's going to do. And we've known that for many, many years. Sometimes there's a higher lending charge, which is additional security. At the end of the day, that's a security. I'm not talking about the ability of the borrower to make payments. That's not really security, that's just good lending practice. So there's your borrowers, that their income, their salary makes payments on the mortgage, and then there's your mortgage, just sort of add things to it. No, security is if they fail to make payments and the lender uses the mortgage deed to claim the property back, repossess it, so that's security. So there are occasions where the lender requires more security over and above just the property, and that's when they call in the guarantor. So who is the guarantor then? Let's just build a big picture there of a guarantor. There's a big person there. A big person. That's the guarantor. There we go. So who is typically this person? Well, typically it's the parents or step parents or whatever of the people buying the property, the typical young first-time buyers. Their daddy or their mummy comes in to help as guarantor. That's typically what happens. And I'll talk more about what happens here, but practically this person picks up the mortgage payments if these people fail to do it. They don't own the property. They covenant to pay the mortgage. They're not on the land registry at all. They just pick up the mortgage payments if these guys don't pay them. So that's a typical one. You might have, for example, limited company lending where the directors of the business are required to be guarantors for a loan. That's not untypical for buy-to-lets, for example, with special purpose vehicles, limited company lending. I think the director of the business is asked to be a guarantor. Now, I'm a director of my own business, limited company, and when we borrowed some money 10 years ago from the bank, I was asked to be a personal guarantor to that loan, even if the loan was in the limited company's name. So that's another situation where it pops up. It's mostly the parents. So what kind of guarantee do they give? Well, they can give a full guarantee or a percentage guarantee. A full guarantee is the entire mortgage debt. So that's the entire mortgage debt, 100% of the mortgage debt they're liable for. And it's not the debt itself, it's the monthly payments for 20 odd years. It might well be that there's a small proportion of that they're liable for. It could be a percentage of the mortgage that they're liable for as well. So that's typically what would happen. Now, be careful with this one, lenders, because you've got to do a few things here before you can approve the guarantor. The first thing is you want to make sure this guarantor is legally capable of giving guarantors. They must be of capacity, in other words, over the age of 18, sound mind, that kind of stuff. They must also be given an adequate explanation of what they're getting into. They've got to be explain what the implications are, and they're advised to have independent legal advice. So these people do need to get some advice about what they're doing. Independent legal advice over and above the conveyances that they're using is a great way of making sure they know what they're doing, because if these people don't make payments, they've got to pick them up for the next 20 odd years. That's really important, that one. Now, if the guarantor doesn't understand, or they're forced to do this under duress, for example, or they make a mistake, then they can actually claim to the court that they didn't know what they were doing. And that's happened before. So when does it kind of trigger into things, really? When does it happen? When does it start to occur? Well, as soon as the people default on their mortgage payments, the lender then will require the guarantor to make payments. The guarantor has no interest in the property. They're not on the deeds, as I mentioned to you. They're not at the land registry. So when would you release them from the mortgage itself, or from the covenants of the mortgage payments? Well, sometimes lenders will allow a certain amount of money to be reduced off the mortgage, and they will then release the guarantor. That's not unheard of either. It's quite a useful one to do. Oh, by the way, the guarantor has to have the same affordability checks done on them that everybody else would have, so their credit search is done, all sorts of things like that. One final thing on guarantors, which has reared its head recently, is what's known as a surety. Now, I'm going to put this in green, a surety. A surety is quite an interesting concept. It's a legal term, surety. And what it means is you don't have a guarantor guaranteeing the payments. You have a guarantor who's got a large lump sum of money that they're willing to give to the lender as surety for the mortgage. I had this years ago when I was working at the Building Society in the 80s. I had this young couple came to see me, and lovely young couple wanted to borrow some money to buy a property. Life hasn't really changed back in the 80s compared to now. And we were trying to look at the mortgage, and we had multipliers of income that we used, and they couldn't afford the mortgage payments. They were just short of what they could borrow. And in fact, it was a high mortgage. People think first-time buyers nowadays have high property prices. It happened in the 80s as well. people struggle to borrow. Now, I said to them, guarantor, parents, are they able to come in and help out? And she said that her parents weren't willing to do that because he was of the school of, they need to stand on their own 2 feet, get on with life. And that's fair enough. So I said, well, there's a few things that we can do. Why don't you get your dad to pop in and see me? And she did. He popped in later on that afternoon, at an appointment, came in to see me. And we had a chat about stuff. And I understand where he was coming from. He was a good egg, this fella. And I mentioned about the surety. He said, yeah, that's no problem. I can do that. So what he did, he went next door and he withdrew, I think it was 30,000, something like that, from the Gateway Building Society. Remember it? He came in with a check. He gave it to me to invest. And what I did then is I took his money and I invested it in one of our accounts. Invested his money. So, he got interest and stuff like that. So it's the same interest rate as he had next door anyway. But I put a hold on the account, a lien on the account, to stop any withdrawals occurring whilst the mortgage was in place. And it was done. I advanced the money to the young couple. I think it was 30,000 mortgage I gave them. And the dad gave me 30 grand cash that I put on deposit. We had a surety. We had this extra security. And the young couple didn't know about this at all. That was the clever thing about it. The dad wanted me to keep it strong, which is fine. So I said to them, we've changed policy. You can have your mortgage now. She was over the moon. They made every single payment. Absolutely. If they hadn't have done, of course, we could have dipped into this money and paid the mortgage that way. Brilliant situation. Think about it. Very, very clever situation. He got his money back when they paid off their mortgage. That's known as a surety. The Halifax are doing that. They got this more, they don't call it a surety. It sounds awful, doesn't it? It sounds like a painful disease you get jabs from the chemist for, but they call it kind of a support mortgage or something. But that's what it is. That's the basics of that. So that's guarantors. I hope that's been useful. Bye. Ha! Okay, do you like that one? I hope you did. I hope you liked that one. All keeps you up to date, doesn't it, what's going on? I think what we're going to do is give you a bit of a bonus today. I'm going to give you some more information about another topic. These are full-blown topics now for you. We're not mucking about here, are we? What I'm going to do for you now is give you a nice detailed topic for another sort of 7, 8, 9 minutes to update you, keep you informed on what's going on. And that's all about debts and insolvency. Well, let's take a look at insolvency and debt problems that clients have or customers have with mortgages. So let's talk about insolvency and debts. Not a very nice topic, I've got to be honest with you. Insolvency and debt problems. Your customer's got a mortgage, whatever, and they're starting to have problems with their debt. They may not even have a mortgage and start to have problems. So why does it happen, first of all? Why do people go insolvent or have debt problems? Why is it caused? Well, it's misfortune, typically. It could be bad management of your finances. It could just be a bad rap, a bad situation, illness maybe, and welfare benefits don't help them. It could be a recession, a loss of job, loss of income, whatever it is. It happens, and we must bear this in mind. So when does it typically happen? Well, typically it happens when somebody's bills, their expenditure exceeds their income. Their commitments, their bills exceed their income, and that's when people go insolvent. So they might have some credit, for example, some loans, credit cards, HP, loans for this, that, and the other, and they can't pay them. So what happens then is that the person that owes the money, the creditor, we're going further, we've got 2 people. We've got the debtor, there you go, and we've got the creditor. And often people get confused with these. Now the creditor is the institution in credit. The debtor is the person that does the owing. They owe the money. So you've got to get those comfortable as well. So what happens then is that the creditor takes them to court. In England and Wales, it's the county court. In Scotland, it's the sheriff court. I love that phrase. It's not like the Wild West, isn't it? But in England and Wales, it's the county court. They go to court, and the court decides how the debt's going to be settled. And they create what they call the county court judgment, which is where you get the term CCJ from. All it is a county court who have agreed or decided on how the debt's going to be settled. Now, if the person's employed, they may well impose what they call an attachment of earnings order. I'll put that down for you. An attachment of earnings. There you go, attachment of earnings. Now that's attached to your salary effectively, so that if you have a CCJ, your monthly payments or whatever the court agrees you've got to do gets taken out of your salary each month. If you're self-employed, people don't have that ability. Now, the whole point is that you make payments, whatever's been agreed, and at the end of it, it's settled. And that's when you get what's called satisfied. So you might have what's called a satisfied CCJ. That means, obviously, you've made all the payments that you need to make, and it's been satisfied. Great word to use, really, isn't it? Now, the problem is that these things are registered, publicly registered, and the credit reference agencies pick them up. So if you go online to Experian or whoever it is, the credit reference agency will have this information on it, of course. It will have all details of CCJs, satisfied or not, for 6 years. That's the big one here, isn't it? And that's where some lenders start to think about yes or no. You know, you go to a lender and they'll say no CCJ is allowed. They'll check it. If the person's got a county court judgment, even if it's been satisfied, they won't allow mortgage lending. There are lenders that do. Some really good lenders, Pepper, for example, does some really good stuff on people who've got satisfied CCJs. And why not? These people had a bit of bad luck. They got back on their feet and off they go. They do proper underwriting, of course, and rightfully so. So that's the CCJ situation. Now, worse than that, of course, is the subject of bankruptcy. So let's have a quick look at bankruptcy. We'll squeeze that one over here. So bankruptcy. Bankruptcy. Yeah, you've heard the term. I'm quite sure. Bankruptcy is much more drastic, I suppose, in the county court judgment. This is where the person's become personally insolvent. They probably had CCJs. They can't make payments. Basically, their assets are far less than their liabilities. They're in a right horrible position, so they're declared bankrupt. Now, when you're declared bankrupt, you often have debts wiped out because you can't afford them. It's a last resort that people get into. If there's a property involved, it's your main residence, the trustees can take over that property and sell it. If it is your main residence, they wait for 3 years before they can sell. Often happens if somebody's about to be made bankrupt, they transfer the property into their spouse's name so that it doesn't get part of the deal. Bankruptcy has a bit of a bad rap in this country. In the US, for example, they think it's a good thing. You know, you're only successful if you be made bankrupt. Whether that's true or not, I don't know. They last for a year, bankruptcy, and then you are discharged. So the 1 year one is often a question in the exam. You're then discharged. You're discharged bankrupt. And you have to let the lender know, of course, because they may not be happy to do that. The credit reference agencies have details of this on there as well. That's bankruptcy. The last one, or second to last one really, which is worth talking about, is what's called an IVA, an individual voluntary arrangement. An IVA, I'm going to squeeze this one down here, an IVA, an individual voluntary arrangement. These are much more common than bankruptcies. What happens here is that you get all your creditors, remember the creditors people that you owe money to, and at least 75% of them have to be in agreement to this one, so less than equal to 75% have to be in agreement to you going into an IVA. And the idea is they all come together, an insolvency practitioner then gets these creditors to agree to lower payments on your bills, so your credit cards, your loans, etc. And the idea is you make the smaller payments. Interest and charges are frozen. So if you've got a credit card, for example, say one of your creditors is a credit card company, and you owe $5,000 or whatever on the credit card. Now immediately the interest rate stops getting accrued, and that's often the problem with credit cards. And any charges stop as well, and that's often the big problem too. And therefore you make payments to reduce that debt. Sometimes they're very small payments as well. Fixed payments, small payments, paid over a period of time. And after a period of time, often the debt is cleared as well. Often you find credit card companies, once an IVA has been sorted, they ain't going to get much of their money back, if anything. So they do that as part of their loss-making situations. Happens a lot in recessions. Happened a lot in the last recession, the credit crunch. A lot of people had IVAs. A lot of companies sprouted up. These insolvency practitioners sprouted up to advise you to come to them, and they'll get rid of your credit card debt. They did it through IVAs. which is pretty frightening stuff, really. The CVA is the company equivalent. That's the company voluntary arrangement. So if you're a limited company, you can do this via a CVA, and it's the same kind of concept, really, before you become insolvent, because that's what happens to companies as well. Last point for you, very quickly, last one for you. Put this one in red because it's the most dangerous one, I think, is the debt relief order. I'll squeeze this one over here. Bit of a mess, really, isn't it? The debt relief order. Now, a debt relief order is a little bit different to these. This is for somebody who just hasn't got a lot of money. They have assets less than £1,000. That's nothing, is it really, in the great scheme of things? Their disposable income is tiny, less than 50 quid, so there's two figures there for you. Assets of less than 1,000, less than £50. You might see that's a question per month. I think it might be weekly, I don't know, less than 50 quid for a disposable income. So these people haven't got a lot to show for what they're worth, and they owe at least £20,000. So why have they got this kind of lending? I don't know how they'd be able to get it. More fool the lenders. But what happens here is that for a 12-month period, the interest rate's frozen. They try and make payments, but after that, it's all written off, and that's a debt relief order. So don't lend in those situations. This is probably the key. More fool the lenders going for it. That's why you get your payday lending from us now, which is a nasty thing, really. But people have a need for this kind of stuff, but there's a situation there with debt relief orders. So that's insolvency and debt, really. Quite a lot going on there. Lots of questions in the exam on this one. As a mortgage advisor, if somebody comes to you and they've got existing debt problems, then you need to start asking some questions, some serious questions to find out what's going on, really, because it might be difficult to place the mortgage case. You're not going to get it in the high street. If they've got a capital judgment, for example, you'll need to go to specialist lenders. Hopefully, they won't charge too much. I know some don't. If there's an IVA or bankruptcy, again, you want to be asking the right question. Lenders will check this in the credit search, so don't think people get away with it. The 6-year rule might make some of your clients not give you all the information they should. That's entirely up to them. But there are questions on the application form they need to ask. So hope that's been useful. Hi. There you go. So a bit of a bonus there for you on our live stream this week, giving you some great information on insolvency, guarantors, and the new execution only. We're live again next week with some more updates for you. Hope you can tune in, if that's the right word to use, for YouTube, or the podcast, of course, is very popular. If you're interested in our bootcamp, give us a call, email me, or we'll give you some information about the bootcamp. All these videos on HD are stored in a lovely little linear sort of lesson plan for you to enjoy. Other than that, enjoy your day. See you soon. Bye.